Okay. All right. Thanks, everyone. Hope you're all getting ready for the big game. Me, I'm not doing anything. Just hanging out. Me and my wife are going to get the fire going, watch the game. I'm going to hope that Travis Kelsey gets humiliated and embarrassed. But you know what? I was just checking out this FedEx. This is a really interesting chart. Let's just think about this, right? And you guys know this if you follow me. Um, One of the main reasons why we get resistance in a market is because we have buyer's remorse. And just think about it. Say you buy a stock at $10 and it goes to 8. You might tell yourself, I made a mistake. I want to get out of this stock. I don't want to lose any money though. So I'm going to hang on to it. And if it gets back up to 8, if it gets back up to 10 and I get out break even, I'm going to sell it. So if you have a ton of people who bought at 10 thinking the same thing that when it went to 8 and they got back up to 10, if you have enough of these remorseful buyers that want to sell, that creates resistance. Now, on the opposite side, for support, it's like the mirror image. People sell, say you sell something at 10 and it goes to 12, and you say, I shouldn't have sold it. If it gets back to 10, I'm going to buy it back. And if you have enough remorseful sellers going to try to buy their shares back at the same price, it could form support at it. Now, there's an old saying on Wall Street, gaps refill. And what that refers to is if a stock is going in, or a market, but if it's, I'm going to just use stock as the go to. If a stock is going in one direction and then all of a sudden it gaps through price levels, meaning one day it closes and then the next day it opens at a very different price, there's going to be no trading in between those two prices. So it's going to look like a gap on a chart. Now, here's the thing, if you're going through a price level really quickly like that, or if you don't even trade at them, there's no one who bought or sold who's going to be remorseful, who's going to be trying to buy or sell on the way back down. So if we gap through price levels, like here on this FedEx chart, there's no trading in there. And then what happens when we get back to this levels going in the opposite direction? There's not a lot of buyers around. You don't have people that sold here who are trying to buy back. So you get this big action lower. And then you get another big gap down here. It's a total gap refill. Some Wall Street expressions are stupid, but some make sense, and gaps refill is one of them. You can see that on a lot of charts. It's not just a gap, but it's just a concept. You if you spend a fair amount of time trading through various price levels, there's a lot of, like, let's call it like vested interest there. There's a lot of people that care. People that sold, people that bought, that want to buy their shares back or sell their shares. And then when you get to those levels, again, coming in the opposite direction, the same thing happens. There's a lot of, market memory at these levels. But if you go through levels really quickly like that and you reverse and you get back through them, there's a good chance, fast move up, fast move down. There's just, even though this isn't technically a gap, the market went through them so quickly, or went through these levels so quickly, that there's just not a lot of time for there to be this vested interest where people are going to be interested on the way back down. So anyway, that's not kind of really what I wanted to get into, but it's a very important lesson. And people say to me all the time, Mark, you make these great market calls. And I say, no, I don't. I just watch the market. Here's another technical analysis thing I always talk about: finding resistance at a level that had been resistance before. This is psychology again. People bought here and, you know, they thought they did the right thing. And a day later, they were like losing a ton of money. And they say, if it ever gets back to where I can get out of break even, I'm going to. So they hold on until it gets back there. Remorseful buyers from here, placing sell orders here, creates resistance. Sometimes they start to undercut each other and there's a lot of selling, but there's not a lot of buying through these price levels. So that's why we go quickly through them. All righty. Okay. Sorry about that. I don't know. I got rants, and I don't just do technicals. I also look at fundamentals, and that's what I kind of wanted to do. Let's go look at the FedEx release and just see if we can get some kind of insight on the economy. So if you type in FDX IR, which is their um, stock symbol, and investor relations. Let's see. We'll go to financial information. Let's see, news and events, earnings releases. I like to see if they have a statistical books. Ooh, that sounds kind of complicated. I like to see if they have a, some kind of a presentation. All right, let's. You know what? Let's go back and just look at their plain earnings release because I don't know what the hell this is. All right, so FedEx reports 303 ahead of adjusted diluted EPS. Adjusted. Now we want to look at the real number. Now, this is one of these interesting things about accounting, right? Here's my analogy, and as you know, I use a lot of analogies. Just say a company has 10 factories, right? And they operate and they make 10 million bucks a year for 30 years, and all of a sudden a factory burns down and it costs $1 million. Well, they'll say, well, if we adjusted our numbers as though that never happened because that's a one-off event, well, we would have just made the same amount of money, right? That's adjusted. If they did actual recording standards, they would have taken a loss on that. Now let's see what we got here. Fiscal 24. Oh wow, look at that. So that's a big problem there too. Okay. This is operating margin. In my opinion, this is probably one of the most important statistics to look at. And basically, if it says GAAP is generally accepted accounting principles, right? So that's what we want. Let's forget this non-GAAP where they kind of mess around with the numbers. So a year ago, for every dollar someone spent at FedEx, they would make 5.8 cents. Now they make 4.8 cents. That might not sound like a big drop, but if you consider it in percentages, that's a huge drop. So I don't think that number is very good at all. And look at that. So their net income dropped from 90, I guess that's 900 million. Wow. Well, anyway, too bad they don't have any presentations because some of the places I really like looking at the presentations are like Caterpillar, when they show these like big tractors driving around. Yeah, now I don't proclaim to be a fundamental guru. I do claim to be very competent with technicals. But yeah, you see operating margins falling off a cliff like that. That's something to pay attention to. Let me go back to that stock. I mean, we are at what might be kind of a short term. Yeah, look at that, right? So it's not a coincidence that this is where it stalled out. It's right at this bottom over here. Maybe it's going to start to get around what we're talking about now. These numbers, you know, are not as good as well, I'm not saying they seem good, but there looks like there's definitely some underlying weakness there. Okay, that's it, everybody. So that's a good technical lesson on FedEx and a good fundamental lesson on FedEx. And hopefully you enjoy the game. And yeah, I mean, I could criticize the halftime show and the commercials now, but I guess I'll save that for tomorrow. All right. See you all later. Thanks, everyone.